Okay, here we're going to be looking at a consolidation of intercompany debt here, and we're just going to go through a basic example here involving a note here. So, for example here, Corporation S, the subsidiary, which is 80% owned here by the parent, borrows $20,000 from Corp P here, the parent, and they do that on 7/1/X1, or July 1st of the first year here. So this note here is for 1 year. And it's an 8% note. That's that $20,000 note here, and the interest is payable on the due date here on 7/1/X2, or the following year here. So looking at our balances here for the intercompany corporation loan amount here, the balance is on 12/31/X1. This is the end of the first year here, 6 months after this note was issued here. So we have trial balances here of the separate statements for Corporation P and Corporation S. So here's Corporation P, here's Corporation S. So we have equal amounts here between the notes receivable here for Corporation P and notes payable here for Corporation S. And then we have interest income here for Corporation P on this note, and then interest expense here for Corporation S. Since they're paying or borrowed this money here from Corporation P. And then we have interest receivable here for Corporation P and interest payable here for Corporation S. And this interest here is based on the fact that there's $20,000 borrowed here for 6 of the 12 months, or 6/12 here, times 8% interest rate for, in this case, $800. And that represents here July 1st of the year X1 through 12/31 of the year X1 here, or for the six months for the first year. Now for our consolidating entries here, using a consolidated worksheet here, and we're looking at the year end here, 12/31/X1, or the first year here. So first thing we have to do here is we have to eliminate any intercorporation debt on this note and any accrued interest here on the note. So we have this note payable to Corporation P here. We debit that for $20,000, and then we have an accrued interest payable of $800. So we debit that for $800. And then we have our notes receivable here from Corporation S. That would be for the parent here, and we'd credit that for $20,000. And then we have accrued interest receivable on that note here. We'd credit that for $800. So going over to our worksheet here, you can see here we have our notes receivable from Corporation S and the interest receivable here. We just take that over here and we credit those amounts here for our adjustment. And then looking at our notes payable here to Corporation P and the interest payable, we take these amounts here, Corporation S, and we debit those here for our adjustments. So what we've done here is we've eliminated our intercorporation debt here, those balances, including the accrued interest receivable and payable here. So the note here, or the debt here, has been eliminated, as well as any interest receivable or interest payable. Okay, next we have to eliminate any intercompany interest income and interest expense here. So for our interest income, we debit that here for $800, and our interest expense, we'd credit that here for $800. So going over to our consolidated worksheet here. First, for our interest income, that was for the parent corporation, what they would receive here, $800. We debit that here for our adjustment for $800. And then because we've canceled this interest income out here, it had a zero balance here for the consolidated income statement. So it doesn't carry over, any amount carry over to the consolidated income statement. And then for the interest expense here to Corporation S at $800 here, we would credit our adjustments here for $800. And again, these amounts here cancel each other out, so carrying it over here to the consolidated income statement would be a zero balance here. So we've for our intercorporation interest expense and revenue, this was also eliminated, and these amounts are equal, thus there is no effect here on the consolidated income statement. So for our interest income here, since the income here balances with the interest expense here, we have a zero balance here for our consolidated income statement. So it has no effect here on our consolidated income statement, this interest income and the interest expense. Okay, now for our distributed consolidated net income. For the income distribution here between Corp S, the subsidiary, which is a non-controlling, has a non-controlling interest here of 20%, and the Corporation P, the controlling interest here of 80%. Their internally generated income includes the interest income and interest expense on this note. So going down here and looking at our internally generated income here for both Corporation P and Corporation S. So for Corporation P, they have an interest income here of $800, and then for Corporation S, they have an interest expense here for $800, and that's on their internally generated income. Now moving over here to the consolidated income, we've eliminated the interest income and interest expense here between the subsidiary here and the parent. So on a consolidated basis here on the income statement, there would be a zero amount here included for both the interest income and interest expense. Even though the interest does not appear on the consolidated income statement, it is a legitimate expense here for Corporation S and a legitimate revenue here for Corporation P, the parent, as separate entities. Now Corporation S will transfer $800 to Corporation P for this interest during 20X1. That's the 6 months here for the first year. Therefore, the basis for calculating the non-controlling interest share is the net income of Corporation S as a separate entity. The non-controlling interest Corporation S here receives 20% of its internally generated income. That was $20,000 of their net income, which is net of this $800 intercompany interest expense. Now for our income distribution amounts here. Looking at Corporation S, so they had sales here of $100,000, and then we'd subtract out the cost of goods sold of $40,000, other expenses here of $39,200, and what I want to point out here is this interest expense here on this note would also be subtracted out. So looking at distribution here, our internally generated net income here was $20,000, and then there was no adjustments to it here to the net income. So the non-controlling interest share here for Corporation S was 20%. So the non-controlling interest here, they would receive $4,000. Next, looking at Corporation P, the parent here, they had sales of $240,000, and then they would include this interest income here on that note of $800, and then they had a subsidiary income here of $16,000. So, and then their cost of goods sold $150,000 less the other expenses of $80,000. That would give us our income distribution here as the internally generated net income was $10,800, and their share here of the subsidiary Corporation S, 80% is $16,000. So their total controlling interest here is $26,800. So in both cases here, the included in the internally generated net income here for the parent was this interest income on the note, and then for the subsidiary they included, or as an expense here, of the interest expense here on this note.